So with that, let's get this show on the road, folks, shall we? Shall we find out where the property sector in this country is heading? I'd like to welcome my panelists up on stage. Please take the seat from my left here, your right, all the way across. Jackie van Niekerk, Chief Executive of Attack. We've got Isak Peterson, Chief Executive of De Pula Income Fund. Isak. Estienne de Klerk, Chief Executive of Growth Point Properties. And Garrett, who doesn't just exist in the metaverse, he is actually here in person. Gary, thank you for joining us up here on stage. Well, I'm just going to take a seat next to you and set the scene a little bit here. Now, Estienne was a little bit worried. I've got to warn you that I was going to be a bit too provocative at the start of the day. But I thought it's important for us to acknowledge that there was a period before the pandemic struck where a lot of the property industry, and it's debatable about who was driving it. Was it shareholders? Was it the pension funds? Was it the boards? But there was an excessive focus on income and generating yield, and perhaps the ball was dropped a little bit in terms of the focus on the fundamentals, the operating strategy of these property funds. And I think through the tide coming out, what we saw was who was swimming without their trunks on. Now, I think it's fairly obvious to state that. The most important thing as we think about the sustainability of earnings, and I don't mean ESG type sustainability, or potentially I do, but how does the property industry recalibrate, and what is that path to the new normal following that period of potentially excessive focus on income at the expense of the balance sheet? I think there has been a lot more focus on the balance sheet over the last couple of years, assets disposed of and balance sheets shored up. And with that, the big question is, what is the path forward? What is this new normal? So, Jackie, kick us off. I know it's been tough for Attack. You didn't declare a dividend, but it certainly won't be lost to shareholders that this really gets rolled up into the NAV as well. But it highlights that focus for you on near-term liquidity and reducing debt. What were some of the biggest challenges for you during the last 2 years?
Oh, good morning, everyone. Sure, you're thinking about, going 2 years back, and I think we all feel it's like 100 years ago when the lockdown happened. As a management team, we said we didn't know the depth of what this will be for us. So what we did as a management team is we said, you know what? We have to clean up our balance sheet and make sure that we can live through this from a health point of view in our balance sheet. And I think the biggest lesson I learned is with a board and a management team is to make a decision on the fundamentals of our business and execute. And we had long, hard debates from execution, and that gave rise to our disposal strategy over the last 12 months that we were quite successful in disposing some assets, and there was questions, why would we dispose, a Deloitte's building, you've just completed it. But it made 100% sense for us at that time. It was a great return, beautiful building, brought a lot to Waterfall, and our balance sheet today is, we're standing stronger today. So for us, the fundamentals were, as you said, key. Focus, listen to your tenant, even though it was unpleasant conversations. You had 1,000 tenants, and we had a small portfolio. So, I take my hat off to what Estienne and Redefined and the rest went through in terms of their thousands of tenants. And as a management team and a supportive board is make decisions and execute on that, and make sure that you've got a healthy balance sheet where we're standing stronger today. So that was our challenge, and I think we have executed on that. And but I certainly think that over the next 12 months, the next path will be an interesting path for us of recovery.
Yeah, well, it is about recalibrating, getting that foundation in place. And that's certainly coming through in the updates that I've seen just in the past week or so out of many REITs that, that bottoming out has happened, and it is now about forging that new path. But I want to remain kind of looking in the rearview mirror, Isak, a little bit longer. And for De Pula, obviously, I mean, the riots were really detrimental for your business and all that COVID pressure. How much did that cost you, and what would you single out as the biggest challenge managing a portfolio through a period like that, which is, I mean, unprecedented is such an overused word, but riots that we would never have expected to happen in 25 years and a global pandemic. How did you manage through that?
Yeah, I think probably one of the toughest times we've been through, or that short period of time. But I must just first add that the communities were just amazing during the time. I mean, our properties got looted through those 2 or 3 days, and you just simply don't know what to do. You don't know where to start. There's no cop to call. Even if you did call a cop, it actually means nothing. You can't reinforce security-wise. So we did all of those things, reinforced, got extra security on site, tried to stabilize the sites. But at some point, you know that it's done. You sort of just watch and get the people doing what they're doing. So I think there was a lot of emotions, at community level that went into that. I mean, when it's almost like a truck falling on the road, SAB truck. People can't help themselves, but they actually just go help themselves to whatever's fallen off that truck. And that effect also kicked in. I mean, there's just so much momentum that went into that thing, so no one could actually stop it. But I think what we saw very quickly after that was the very next day or a few days after that, not just our teams, but everybody was on site cleaning, and it was communities. And some of our centers that were not attacked in the townships were actually centers where communities actually came up to us and said, no, we'll look after these centers. And going back to the sites afterwards, the questions were, when are you reinstating? It's so inconvenient for us now. It's expensive for us to get from this point to that point. We want our centers back. We assure you it will never happen again. So, I mean, my sense is that there might be looting happening, that might happen in the future, but I don't think it's going to be to the same scale. In terms of cost, obviously, it was quite expensive. I mean, our single largest loss was on one property was about 30 million rand, and then the rest was a bit tapered down from then. Interestingly, KZN was not the worst affected. I mean, we were worst affected in the Gauteng townships, and that's where our biggest losses were. So, yeah, I think lesson out of this, obviously, South Africa's got big issues, inequality and all these other things that we worry about. Poverty is an enemy. I think as an industry, we need to be conscious of that. And yeah, I mean, I think, as I said to you, we're rebuilding. All the centers are back trading now to different degrees. It's only one that's not 100% trading, but I mean, most of them are actually back trading again.
And when I hear you talk about that, it actually brings home this focus now when we talk about ESG on the communities and on the S in the ESG, and how you potentially going to be able to capitalize on this as a silver lining through what has been undoubtedly one of the most difficult periods in your history. But I just want to move on, Estienne, to your experience, and obviously V&A, the sort of crown jewel in the portfolio. And I mean, we know just how much tourism was impacted by COVID. And just as we thought things were going to get better and turn around, then another Greek letter of the alphabet came along just before December last year. So, I mean, what's been really tough for you over the last 2 years? What have been the big challenges, and how did you approach overcoming these?
Yes, so I mean, clearly the V&A has got a big component of its trade is the tourism sector. And the reality is the management team, who's a very capable and able team that's been there for some time, worked closely with the industry and the property industry group in terms of negotiating with the tenants, and even still today, in certain cases, they're having to work with the hotel groups, for instance, in these difficult times. In saying that, if we look at October and November this year, trade picked up significantly, and in fact December's trade has been very, very good in the V&A. Clearly, mostly South African tourism, if you'd like. The international tourism is starting to sprinkle through now, which is a huge positive. But it did help that the V&A as an entity had two strong financial partners in Growth Point and the Government Employees Pension Fund managed by the PIC. And the management team, was very able and certainly actively took the reins in terms of managing the process and helping those tenants through the difficult times. It's the first time I think you can get a restaurant spot at the V&A if you're a tenant, I think, in some years. So certain sectors have been brutally impacted. But, you know, we're looking forward. We're very optimistic. It is South Africa's jewel, that asset. It's the most visited property on the continent. And, you know, if you're a tourist and you're spending $1 in Cape Town, 60 cents of that's going to be at the Victoria and Alfred waterfront. So the reality is it's important for us as a country to have that asset up and running and working very, very well. And I think we're on the up in terms of certainly earnings as it relates specifically to sort of the growth point side of things and the investment side. And then from a trade perspective, I think hopefully we're over the back of it. But it wasn't easy. Interestingly enough, just on the topic of the riots, we did a survey. Joanne helped us just with a little bit of a survey amongst the top 20 odd REITs, and the losses in the REIT sector was just below 1.5 billion rand in terms of damage done to that, and that was actually concentrated. There were 2 REITs that unfortunately suffered probably disproportionately more, in that they had 2 very, very large properties that were totally destroyed. So it was tragic.
And that's just the tangible losses. That's not even to mention the intangibles around confidence and how long that takes to rebuild. And as we know, confidence is the cheapest form of stimulus. So it is encouraging to hear you say that you're seeing these green shoots and potential opportunity. If you want to go and open a restaurant at the V&A now and you want to be positioned for the bounce back, now's the time.
Correct.
Gary, I want to move on from your vantage point. Talk to me about the quality of the management responses that you've seen over the last 2 years. And I mentioned it in my introduction around what really struck me when I was in Eastern Europe is just how highly regarded South African management teams are. What stood out for you over the last 2 years?
I think what I saw right up front was a group of people getting together and working together, trying to figure out where potential blockages or hotspots could be, and really then negotiating with key stakeholders in the sector, whether it was financiers or with tenants or regulators. I think that was critical. It was a really proactive approach that was taken by many leaders in the sector. And I think what was important about that is they didn't come together just because of their own companies. They took this stance for the sector as a whole. And if you think about the sector, many of our properties are held by the kind of the REITs, but a large proportion of players in the sector are really small unlisted businesses. They're individuals. And I think that some of the frameworks that were created by the property sector industry group really was instrumental in limiting some of the damage that could have happened and that was predicted for our sector. So, if I look back at the uncertainty that many of these management teams navigated, through COVID, through the riots, I think it was an absolutely incredible response. I think if you look at how they just focused on their businesses and their portfolios and made sure those were as defended as well as possible, I think that stood out. But when I look at it all, and you said it earlier, we have some absolutely world-class management teams here. I think as a bank, we can see that and we acknowledge it. And, I would hope that many investors into these businesses realize what these management teams went through and what they did through this period. And I think we came out of it, we're not out of it, but we're out of some of the immediate crises in far better shape than many people predicted.
What really stands out for me, and it's an overused word again in business, is ecosystem. What we saw through the last couple of years was a realization that there is an ecosystem, that you kind of rise together and you fall together. Etienne, I want to bounce it back to you. And going back to that panel that we had during the hard lockdown 2 years ago on Business Day TV, and no one kind of knew what was going to happen. How long are we going to stay in this hard lockdown for? So much uncertainty. Businesses couldn't trade. I couldn't go and get ties for my show. I couldn't buy cooked chickens and open-toed shoes. I mean, we just didn't know what was going on at the time. Yet here we are today, and things are looking much better. What does that boil down to you?
Yeah, I think, maybe we were a bit fortunate from the perspective that when we went to Australia in 2009 as Growth Point, it was right in the eye of the GFC, and we saw the damage that the systemic risk of uncertainty in the financial markets could cause. So the immediate response to that crisis facing the real estate industry was to ensure that as an industry we deal with most of these systemic risks in a coordinated way. And the reality is there's a lot of people in the room here today who played an incredible role in the specific work groups that were set up at that point, dealing whether it's with the banks, the financial institutions, the equity partners that we have in the investment markets, and then clearly what was a big component was dealing with very, very upset retailers, and their initial stance was, we're just not going to pay rent, and everybody was battening down the hatches. I think most of the real estate companies immediately also looked towards their balance sheets, looking at liquidity and ensuring that they'd be able to survive through what was quite an uncertain period. So I think that collaboration, the fact that, I think Gary mentioned it in his opening address, the fact that we dealt with that up front, it was very, very painful. Don't make a mistake. I think the REIT industry probably was a bit of a shock absorber between the economy and the financial institutions, which they're very grateful for. And the reality is that the tenants, I think, through this period had an appreciation of what we were trying to do, and albeit painful, it was quick and it was much more efficient. So I think that stood us in good stead coming out of those initial very difficult lockdown periods.
Yeah, well, I mean, it's always the old advice for a good relationship, healthy relationship to succeed. You've got to have the difficult, painful conversations, and that's certainly what the industry did. Gary, from your vantage point, it's always said that if you owe the bank $1 million and you don't pay, it's your problem. You owe the bank $1 billion, it becomes the bank's problem a little bit. What was your perspective through that period and being on the hook here?
Look, I think banks learned a lot about how to respond to crises in the global financial crisis, and I think banks incurred some significant losses for a variety of reasons, but one of them was probably not working closely enough with clients. I think through this period, banks ultimately don't want to end up being property owners or like some of the biggest property owners in the market. Properties can be managed best by the teams here and by people who own them. So it was critical, I think, that banks worked with clients across the board, including in the property sector, just to make sure that there was sufficient kind of liquidity through that period, and liquidity relief created for different players in the sector to be able to manage their way through it. And I think, one thing I would acknowledge, which I don't think always is I think the banking regulators really came to the party through this and allowed the banks to be able to create some flexibility, to restructure facilities, to grant liquidity relief through this period. I mean, to give you a sense, pretty much 2020 for us was about restructuring facilities, and we probably, and we didn't have to do very much for the REIT sector, but we probably did end up having to restructure 1,300 facilities with our different client base, just to create that breathing space. And I guess if we weren't able to do that, if the banking sector wasn't able to do that, there would have been a disaster. And if the regulator hadn't allowed us to do that, we would have kind of blown our capital. So I think that was important.
Certainly the fact that the banks didn't panic created huge stability in the real estate sector, which was amazing through that
Again, but just taking that ecosystem-based approach, understanding that the issues you're addressing here can become systemic quite quickly, in which case it's like a Jenga tower where the whole thing falls down if you do move too swiftly. Jackie, just to move back to attack and you know, to come back to the way you managed through this process, and I just want to get a sense of the kind of reaction that you first had sitting down with your board and your team when you said, right, we don't have much line of sight, we don't know when this pandemic is going to end, we don't know when trading is going to resume. Just take me through those conversations that you were having around the boardroom table.
I think we just started with a risk matrix, if I remember correctly. Raj and the team started, and which you've put aside. I think if I listen today, what struck us, and if I think about it, it was about our staff, it was about our people. And today clearly was about the friendships in this industry. It was about the property industry group, the banks holding our hands, listening to us, understanding our problem. And I'm grateful for the calls that everyone took, from each other and, listening to each other in the times and applying support. So for us, it was really, giving the staff clarity, confidence. Attack's not going anywhere. You've got job security, and let's do our best, day by day, step by step, lease by lease, facility by facility, disposal by disposal. And I think that's how we got through it. Like I said, we started off with a risk matrix, and our people made it happen, and our JV partners made it happen. And we came out of a pandemic with more JV partners, understanding we also can't do everything on our own. And then we had to take hands. And I think for that, I'm entirely grateful. And, and I think our business moved from, as you've opened up, in the oil industry, it was always about the yield, the returns, the NOI growth. But I think we've also started finding our purpose. It's business with a purpose. We've lost people. We've seen colleagues that went through tough times. Spouses lost work. Some of us became very creative in making craft beer at home, or pineapple beer when there was no alcohol. We all had to find our personal life with homeschooling. But our businesses also had to find that purpose. And I think through the people in our community, we did that. And I'm entirely thankful for holding hands on that, and I think that's how we got through it.
To build on that, and to come back to what you said about the communities actually rallying around your properties and your assets, how does that set you up in terms of your pathway out of the pandemic now in recalibrating that foundation, not only with your communities, but with your tenants as well? What is that relationship like?
I think a few things happened as far as I'm concerned. First thing is that I think the banks got to understand our businesses better. Because, the first thing that happened with us when this pandemic broke was, wow, what's going to happen to our cash flows? Because it's a cash flow thing, right? If we can't get the money in from the tenants, what's going to happen? Are these tenants going to trade post-pandemic, and how long is this thing going to go on for? And therefore, how are you going to plug those holes? Before you even think balance sheet, you're thinking cash flow, which is a big thing in our lives type of thing. So, I suppose from that point of view, we think that we understand our business a bit better. We think that our stakeholders understand our businesses a bit better. And we're becoming clever in how we tenant, because we do understand that obviously it becomes a credit issue. It becomes about the underlying balance sheets of our tenants as well, in terms of whether they can survive through pandemics and that sort of thing. So we're starting to think tenant mix. We're starting to think that yes, our portfolio actually carried us through this thing, because from a retail perspective, we've got a defensive portfolio. We've got lots of basic tenants in our portfolio. So most of them were trading through the pandemic. So if you look at what we collected during COVID, relative to peers, it was always a higher number because of the structure of our portfolio. What also surprised us was that, with all their fault, government was actually a brilliant payer throughout the pandemic. They paid on time. They even the month-to-month leases that we were running were paid on time and that sort of thing. So the key thing here is our teams are a lot more flexible now. They can work from the office or from home, and it's a question of now, as I said, understanding the strength of our portfolio and working towards that, improving it even further. And yes, the big question at the time was also valuations across the sector. What's going to happen to valuations in it? And there were shocks to valuations, and I think some of those shocks were temporary. If you look at last year, the sector really recovered. And the key thing, again, from an investor point of view, I know there's an obsession, there had been an obsession with income or the level of distributions. But just the sector starting to declare distributions again gave us an amazing bounce as a sector last year, if you just look at how the sector performed last year from a share performance point of view.
Building on that, and the country really finds itself on the horns of a dilemma now. We had the Presidential Economic Advisory Council last week urging the President ahead of next week's State of the Nation address to start moving on some of the reforms around energy and network industries and ports. And we know how much export earnings we're losing because of issues around Transnet, not being able to export coal. We have record high unemployment after the pandemic, jobs lost across the board, riots last year. It doesn't look like the kind of environment from the outside that would encourage investment. So what gives you confidence to invest?
Well, I mean, I think we've got 60, 70 million people in this country. Our business is SA focused as things stand. We only buy or put up stock on the back of tenant demand. And although the macro picture is not looking all that great, I mean, these areas still need to be serviced, And I think some of the macros, just from a confidence point of view, could be turned around fairly quickly through the language, the government's language itself, coming through with a few of the promises in terms of the infrastructure spend. They're speaking about stabilizing, dealing with crime, simple things that they can deal with. But I mean, we don't look at this thing over 12 months or 6 months or over election periods as politicians would. We're looking at this thing long term, and we're saying to ourselves, is there still demand for the product that we're putting out there, and are the people that are occupying our spaces still looking for that sort of space? Obviously, I think, the model there's different stresses on the model. You can see, the costs are out of kilter now, all in cost of occupation for tenants and that sort of thing, but building costs are going up. Where are feasibilities sitting? In a funny way, the fact that feasibilities are becoming difficult is going to underpin property going forward. So, I wouldn't say that we block out all of the negative from a government point of view. I think we can only do as much. I mean, we bargain as far as we can as an industry with them. And then we start saying, okay, now what can we do at the micro level that actually shields us from the bigger negative around us? And as I said to you, there's great demand for a lot of our products out there, a lot of the space out there. And my sense is that obviously government came to the party. We criticize them in many ways, but dropping the interest rates to where they were dropped, dealing with, and regulators coming to the party, as Gary was saying earlier on. There were positives that came out of this, but these larger structural issues are complex. I don't even know where to start to actually resolve them.
Yeah, well, if we could solve them easily, they would have been solved some time ago, wouldn't they? And I always love chatting to property owners about risk, because if anyone understands risk, it's someone who's sinking money into physical assets in the ground. You can't wrap up a shopping mall and quickly head offshore with it. You really need to have a firm view on what the risks are. Let's zoom out a little bit, Estienne. Looking at the global macro environment at the moment, if I hear inflation one more time, I think my head might explode. It's all we're talking about at the moment. The Fed and the ECB announcing this week, some in the market reckon 25 bips. So interest rates are going to be rising. Inflation is rising around the world. That's generally pretty good for property, isn't it? Because you would start to pass some of those increases on. Or is that not possible in a constrained economic environment like South Africa's? How do you read it?
So clearly we've been suffering severe inflation and administered costs for many years. The past 10 years, municipalities have been, if SAPOA's information is correct, increasing it by over 10%. So margin squeeze has been prevalent in the sector for some time. And it is a very big project that SAPOA is busy with in terms of they're providing research on that specific area, and they're looking to address that with the Minister of Cooperative Governance in this coming year to try and see if we can maybe deal with that specific threat in respect of rates and taxes. Big picture inflation, clearly initially it's going to be a little bit difficult for the industry if interest rates rates go up, then yields generally go up with it, which puts pressure on the share prices across the board. We've seen quite a lot of volatility in the market as a result of maybe some of the noises coming out of the Fed and the developed markets interest rate environment. Over the long term, I think it was alluded to here that that can actually benefit existing real estate owners, in that if what underpins those rentals quite often is the cost of new development, and if it costs, let's say, the equivalent of 100 Rand a square meter in rental to make a feasibility work, and the existing rentals at 75, it does lead to some positive pressures over time. But in the initial sort of environment, I think it will be something that conservative treasury management will be an important component for REITs to focus on, ensuring that they've got sufficient amount of hedges on their debt. If we get severe increases in interest rates, as an example, on the back of high inflation, then then they have to make sure that their debt book or their balance sheet is correctly structured. But I think over the long term, actually, inflation is real estate's friend to some extent.
Yeah, and it's also about the pace, as you said. If the Fed, which some are worried could be far too behind the curve, then it might have to be far more aggressive than initially signaled, and that certainly could be a challenge. Gary, would you like to add anything to that, the kind of macro picture that's facing property at the moment, both globally and obviously locally?
I'm probably not an expert on what's happening internationally, as much as some of the teams would be owning properties in different markets. But I mean, I do think there's rising rates coming. Obviously, I think initially we were, as Nedbank, forecasting 3 25 basis point hikes this year. I think there's concern that that could be a further 3, so we've already had one, and there could be 100 in the year. I think, though, fundamentally that it is going to be driven by what happens in the kind of major international markets, because I don't think we're going to want to see a dislocation between what we do and what ultimately happens in those markets. I think, like many sectors, the property sector will remain under pressure, because it requires a growing economy, really, to really build the sector. And at the moment, I think, everyone can't see where that real kickstart's going to come from. So while I think it'll remain relatively difficult, as I said, I think we have management teams who understand that and understand how to manage their businesses. So I don't foresee, any type of disaster for the sector at all.
Let's build on that last third of the panel to go. Jackie, what does the path out of the pandemic look like for you after this 2-year period? You went back to basics, did all of your SWOT analyses, you rallied the team, you've delevered to some extent. It's now about building for the future. You can't control what's out of your hands. We'd all wish that we could control the economic growth rate and get us up to 5%. So what are you focusing on?
Basics, fundamentals. So we're an SA, pretty much an SA-focused fund. We focus on precincts, not, standalone buildings. We firmly believe safety, security is a big concern in South Africa, and we offer that in our precincts. Our capital allocation needs to be razor sharp, very disciplined over the next, I would say, near future, to ensure that, whatever we cannot control, we can, we buffered for and we protected for in the future. So for Attack, it's an SA play. We certainly back the country, we back the people, it's a razor-sharp, focused approach on our portfolio and preserving and building on that portfolio, and then unlocking also, the income streams that we now understand better in our portfolio than what we did before COVID. Optimistic, but also, very cautious for the next few months and also years to come.
I think being disciplined in your capital allocation now is actually going to be quite a challenge, because I can also imagine that there are some very attractively priced assets in the market at the moment that one might want to pull the trigger on. Is that, anyway, for Dipula, what is your path out of the last 2 years in the maelstrom into the next 12 months?
Yeah, I think one other big thing for us was that, we realized how constrained you could be if you're stuck in I think we had a capital structure that just wasn't working for us. I mean, we could have had opportunities in the past where our growth would have been so much faster and better, and we could have improved our portfolio even significantly more than what we've done over the years, but we were constrained by a capital structure, and our capital was just mispriced, so like completely mispriced, and we couldn't do anything with it. So I mean, our priority is, again, I mean, we know what our strengths are in terms of portfolio. I mean, we're going to focus. When the time comes that our capital is priced correctly, obviously we'd like to invest more into that. But on the ground, simple things: people must show up, those rentals must come in, and we're going to be completely focused in understanding our tenants a bit better, so that we are responsive to what their needs are, not what we think their needs are. And the key thing is, try and keep that balance sheet, healthy, so that we don't spook off our banking friends, in terms of, getting that costed wrongly, or, and so on. And I think, again, as a sector, some of the things that we were going through as a sector with maybe nervousness around valuations and things like that, I think some of that is kind of behind us. I think there's probably a chance that the market might believe the NAVs a bit better, and that gap between NAV and share price might close going forward. And then hopefully things like that. So we're all saying, let's fix our house now and just prepare for the better days. And where we see the gap, we'll take it, type of thing. So we just have to be more innovative in terms of how we're running our businesses and how we're executing on opportunities going forward. But yeah, I certainly believe that, from an institutional investor point of view, hopefully the debate around whether, there's these NAVs are not real is behind us now.
And I was going to sort of conclude around that question around whether or not you see those discounts to NAV narrowing over the next 12 months and yields improving. Estienne, I don't know if you want to build on that, but also, with that lens of innovation and opportunity, where do you see the opportunity in this market at the moment?
Yeah, so I do think that, if you start seeing stability in valuations, I think you'll start seeing more M&A activity starting to come through, where there's a bit more certainty on income streams going forward. You can do deals. I think, certainly from a growth point perspective, we've looked at continually diversifying our income streams, and there are definitely areas of opportunity where there's strong demand still in the economy, and if you can basically, gear your business to benefit from those, they definitely will prove to be valuable over time. The South African economy remains a big question mark and a big driver, and as a result, I think one will have to be very circumspect as to exactly where you delve for your opportunity. But I do think that if you look forward, I think there will be consolidation in this market coming. I think those that are brave and opportunistic will benefit, and I do think that there's value to be had, because the market is pricing the environment for perpetual negativity, whereas certainly our view is that over time, that negativity will start coming out of the fundamentals, and we can start seeing already as we speak some of these fundamentals are changing in the various sectors.
It reminds me of a conversation I had with the founder of Investec, Ian Cantor, and Stephen Kossoff a while back about founding Investec back in '76. The Soweto riots. It was a contrarian view to be building a business that my former colleague David Gleeson rather unkindly referred to as a bucket shop, which always used to rib Stephen a lot. But he said that was when the best opportunity arose to acquire assets, because assets were very attractively priced, to acquire talent as well. So it sometimes does require a bit of, shall we call it, testicular fortitude to put your best foot forward. Jackie, where do you see the opportunities? And you mentioned additional revenue streams that potentially have emerged now through the pandemic. Can you just take me through how those are now playing into your business?
Yeah, I think if we look at our business, especially in Waterfall, is we've got an economy of scale, business, I think Eastern, you also at the waterfront. But the e-space, we definitely see, the green space, we're unlocking revenues in our existing assets. We're definitely putting a lot of focus and attention. It's not just ESG, and I spoke about it earlier, it's finding that purpose for ESG in our business. And we really said is, if we really want to be a purposeful business, E must play a role in driving cost of occupancy down in our portfolio, the economy of scale. So it's not just putting PV and we get a green plaque on the building, and I say it with a lot of respect, but it's really driving and unlocking the return out of that building clever. So for me, that's the phenomenal opportunity in our portfolio, and then also having it not just singularly focused, but on in a precinct focused, looking at our E strategy, waste, water, electricity, and then also driving, the digitalization. Isaac spoke about, really getting to understand your tenant or your behavior of the shopper. We've seen shopping behavior completely change throughout COVID. Footfalls are down, turnovers are back. What do the people actually want? How are they shopping? And really investing in that digitalization of our business, in the data points that make our business tick, and how do we incorporate that into our day-to-day management. So I think there's amazing opportunities, in our ESG space, incorporating that through our purpose, and then also understanding the data points in our business. So I think there's a lot in our industry, especially in South Africa, that we can still mine, that potentially can bring long-term sustainable income and not short-term. Property is a long-term game.
Yeah, and sustainable in both senses of the word there. I'm really looking forward to that ESG panel a little bit later. Isaac, if you look at the opportunity in the areas in which you operate, I'm always fascinated sitting down and speaking to a guy like Gigi Alcock, for example, at just how big the informal economy is in this country and how much opportunity sits underneath the surface there. Where do you see the opportunity?
Yeah, I think as you say there, like we sometimes can't explain the numbers because I think there's a big part of our economy that's unrecorded, from a stats point of view. So I mean, it's certainly our experience that there's a massive informal economy in the areas that we operate. I think we just take the taxi industry on its own and all the businesses that those guys own, etc., etc. It's a massive economy and it's unrecorded. So we certainly believe that there's still a huge opportunity there, to continue to invest there. And our focus is obviously to continue to build on that retail portfolio, perhaps not buying as much offices as we stopped buying offices a while back already. So I mean that sort of trend will continue, probably trade out of most of it. We've still got a little bit there, but it's not an obsession to trade out of it. I mean it's all in a sensible way, because as I said to you, we were lucky that office component was actually government tenanted, and they came up with a rent. And yeah, from there I think it's a question of just reading that market right and investing in locations, between retail and say a little bit of industrial or logistics and that sort of thing. So rather pick the locations a bit better, pick the assets a bit better, manage these assets brilliantly. And the beauty of the Pula is that, I mean, our team has been stable. I mean, people have been there for years and years. So I mean, we've been learning together, dropping off what doesn't work, and the question of becoming more efficient in terms of how quickly you get information. This prop tech side of things is also important. I mean, we're building our own models on top of, of existing property management systems now to give us an edge in terms of where we're going. So there's a lot of focus on what we can control in the short to medium term, and then obviously long term, it's got to be scaling. We have to scale our business in one form, shape, or the other, be it participating in corporate action or whatever that might be going forward.
One might cynically add, with the government being a good payer, that not many civil servants lost their jobs through the pandemic. Certainly not as many as we saw in the private sector, backed up by the taxpayer there. Estienne, I couldn't help it. I told you I was going to be provocative today. What are your concluding thoughts as we've got a couple of minutes to go at a time when, let's face it, remaining listed in this environment isn't attractive, and it's a global trend. We're seeing towards delisting, going towards private markets. That just adds a further headwind, surely.
Yeah, I think the period that we've just gone through has tested the REIT model, if you'd like. So, you know, we were, as an industry, very involved in establishing REITs for South Africa with a regulatory framework, and certain components of that has been tested and maybe found wanting. So the fact that you're forced to pay out distributions fully in a difficult environment is a bit tricky, and some of these things we'll have to start you know, talking to the regulators on, and that has commenced. I think another thing that you've mentioned, ESG is increasingly important for the investors into our sector, and will be an area that has to be addressed from a SA REIT perspective. You know, certainly we're going to look at that in significant more detail, assisting our members in improving the game across the board. And I think from a business perspective, you know, everybody will be actively continuing to see whether they can find value and extract that in the most efficient way for the benefit of the investors in their respective companies. So from a SA REIT perspective, you know, we will continue to drive the specific working areas that we have strategically focused on, and I believe over time, you know, that will mean that we'll probably work much closer with some of the other industry bodies, and potentially even see some consolidation in that area, and give property a much stronger voice as a member of this economy, and a contributor to the GDP.
And I really hope at a local government level that, certainly what we've seen with the local government elections recently, that there is some pressure from the bottom up for real reforms, because that is the interface, and you mentioned it earlier, the administered price increases that we've seen, the lack of security, potholes outside malls, all of those things, sewerage, that really needs to be sorted out. That's really the coalface of delivery. Gary, we've got 20 odd seconds left. Would you like to wrap it up for us?
Yeah, you know, perhaps I think a discussion we were having is, you know, why do we think the sector fared better than many predicted? And I think there are many reasons, but I would probably bring it down to just a couple of quite basic items. The one was that property sector group, and we'll never know what the outcome would have been if that wasn't formed, but I think the outcome was a lot better than it could have been. I think the other was property owners really just focusing on their own properties and making sure, and we've talked about it, the fundamentals were sound. I think the piece we haven't mentioned is around communication. I don't think you can ever under-communicate with investors or analysts or the market. And I think what we saw is a consistent set of communication coming out across the sector. I know we spent a lot of time as a bank talking to banking analysts because of the size of our exposure. And through that consistency, I think, you know, things played out as participants in the sector were saying they would, as opposed to the dire situation being predicted. And I think in that just built a lot of credibility.
Yeah,
and we should build on that.
And a foundation, exactly, that you can build on for the future. Well, we have to leave it right over there. We've run out of time. Garrett, thank you very much. Warm round of applause, everyone, to the panelists. Etienne de Klerk, Isaac Peterson, and Jackie van Niekerk, thank you very much.